Francois Savary, good morning. How are you
Good
this morning?
morning. I'm fine, thank you.
I think your thoughts are that implied earnings for 2024 are unrealistic. I think that's fair to say, isn't it?
I
Based
think
on
it's
based on various criteria.
I
What
agree.
are the judges calling? What are they saying?
Oh, it's variable. I would say if you take the more negative one, which are JP Morgan. JP Morgan is calling the market at 4,200 by the end of 2024. The most positive are calling it for 5,400, which is RBC, and the average is around 4,660 in among the main, I would say, US investment bankers. So that gives you a picture, and there is a wide difference between 4,200 and 5,400. This is quite a huge gap to fill, and it's connected to the perception that you have on earnings next year.
What does that imply for earnings next year if we're talking about 5,000, say?
It tells you that the growth of earnings next year should be around 10%, considering that the PE of the market is quite elevated for the time being, because the PE forward is around 19 times, which is not cheap by historical standards. So you can't expect, really, to my point of view, that there will be a PE expansion next year. So with a kind of PE staying where it is, it means that you need to have close to 10% EPS growth next year.
I understand. So you're saying either the PE has to go much higher, or the earnings have to be higher. There's no other way around for it.
Exactly. Those are the two factors that are going to that can drive your market. It's the valuation, the PEs, or it is the reality, the economic and financial reality, which is the earnings.
There was two numbers that were quite interesting yesterday that were announced: productivity and wage costs. They were quite good. This could help some of the more bullish strategists. What do you think?
I think that you are perfectly right. The numbers first were very good because they are showing that the productivity is really increasing significantly. Yes, it's only the beginning, and you cannot call it a trend because it's only for 2 quarters now that you really see that something is happening in the productivity. It needs to be confirmed over the coming quarters. And the fact that unit labor cost is coming down by 1.2% is very good. It's very good for companies. It's very good for earnings. Why? Because it tells you that margin expansion or margin stability is possible next year, which is going into the story of the resistance of earning per share next year. But don't forget that there is first and foremost something that is more important than the unit labor cost and the margin. It's the fact that you need to grow your top line. You need to see sales and income increase in order to support EPS next year. But it's a good thing. It's a good number, and it's going into the case of those who believe that earnings are going to be good in 2024.
And Bill Ackman is calling for a cut in interest rates in the first quarter already. He's way ahead of the curve in terms of market expectations. I think the market is still expecting June or July in terms of rate cuts. What are your expectations on real interest rates? Why is this so important at the moment, and where are we? Can you also which inflation numbers are we talking about in order to ascertain real interest rates?
Okay, if you look historically, you are close to a level that we reached around 2008 just before or along the great financial crisis. Real interest rates have gone up quite significantly in the course of the last 12 months. But lately, due to the fact that you had the recovery on the bond market, they have come down quite a lot in a matter of a few weeks. I would say that by historical standards, real interest rates are not that high. They are on a positive trend. That's something that is quote unquote worrying for the economy and quote unquote positive for the economy. Why? Because at the end of the day, real interest rates is what matters for your ability to grow. Usually it determines the level of growth you can expect. So what I'm saying is that if you have higher real interest rates, it means that your economic activity is stronger than it used to be. And the difficult matter is which level is the right one. What Bill Ackman was referring to is, okay, maybe the real interest rates have come up so much that they are going to weigh on economic activity because the growth potential cannot support such a quote unquote high level of interest rates. The other side of the picture, you could say, is no, the market is just adjusting to a reality. Is that after a very, very bad decade in terms of economic activity, we are going to see much better growth, well, much better, maybe instead of 2%, 2.5% in the coming decade, which is quite a lot. It means that interest rates need to adjust to the upside, and it's just a reflection of the fact that economic growth is going to be stronger over the medium term. That's a key debate because nobody knows, nobody has the answer, but it tells you how important this question of real interest rate is for any person who is dealing with financial market. Which kind of inflation expectation do you take into account? You can take many. You have many. You look at the expectation, for example, in some of the consumer Gallup, like the Michigan survey, you have some inflation expectation. You can look at the inflation break-even level, and that gives you a kind of inflation that you need to take into account. This is, you need to make a choice. But at the end of the day, they are showing the same kind of pictures. We are living with higher interest rates. Is it sustainable? That's a big debate.
Surely that's going to be a large influence on the S&P 500 and its possibility to create the extra earnings that the strategists are looking for.
Exactly. That's exactly that. At the end of the day, you can relate the real interest rates to the ability of the economy to grow and the ability of the economy to deliver earnings.
So what you're saying is, although real interest rates aren't that high, it does imply that the expectations for the S&P 500 are maybe too bullish. Therefore, you think the economy can withstand real interest rates at these levels for quite a long time, but maybe it will have an impact on the economy.
It's it's a process of trying to find an equilibrium. It's not something that is completely. It's not something that is stable. You need to find an equilibrium. We all know that lately economic numbers coming from the US are telling you that economic activity is decelerating. So the remark of Bill Ackman, what he's saying is that the Fed is behind the curve. The Fed has not understood that the economic activity is slowing down because interest rates, and real interest rates in particular, have gone too far, too fast. Okay? That's what he's telling you. So what is interesting in this debate is how much is Bill Ackman right? Is the US economy beginning the deceleration? And because of the high level of real interest rate, it's going to continue to decelerate and go into recession? Or are we in a situation where the people who disagree with Bill Ackman will say, no, it's because you are living in a soft landing environment that you are going to live, you have the ability to live with higher real interest rates because the US economy proved stronger than was expected by many 12 months ago.
If the Fed reacted like Bill Ackman is asking them to do in the first quarter, what is the lag time on the real economy from interest rates?
Usually what people have in mind and what historical numbers tell you, it's between 12 and 18 months that you see the impact of a rate hike into the economy. Nevertheless, there is something, again, we are always living in different worlds, and we are living in a very particular situation, which was connected to the COVID. In the US, you had an accumulation of huge amount of savings that was connected to the government policy giving checks to people over that period. This was a significant amount of money that supported consumption. So people look at the lag with that in mind, and maybe it impacts the lag the real lag that we have on the economy. And instead of having such a linear relationship, maybe for quite a long period of time during the tightening by the Fed, the consumer has been able to consume because he had this excess saving. So the reaction to the interest rates hike did not materialize as expected. So you need to take that into account, but clearly with the amount of rate hikes that were provided by the Fed, this is now that you are going to see the impact in the course of the next few quarters really on consumption and the economic activity in general.
What would you like to see the Fed doing therefore next year, and when?
To me, they will not. What I would like them to see is to keep a policy. It's very difficult for them. You know, when you lose some kind of your credibility, as they did, most central bankers lost credibility in the course of the last 2 years. I think that their main focus should be to regain credibility. Mohamed El-Arian wrote an article lately about the fact that they need to really convey a message that is clear, and they need to focus on the message. And he is not wrong in saying that there is a lack of ability from the Fed lately, and by lately I mean over the past 12 months, to really deliver a message that people took into their expectation. People are modifying their expectation much too quickly, and this is very dangerous. So what I would like them to do, first, I would like them really to focus on this message. They need to really build a credible message. And I think that they should not lower interest rates too quickly. And they are data dependent. They should remain data dependent. And be aware that it's not because you had one or two numbers on the inflation front that were better that you can consider that you have won the fight against inflation. And I would expect them to lower interest rates at the end of the second quarter of next year, and not in May or even in April, as some people are expecting right now.
Lastly, here's a bit of a curveball. What's your expectations for the S&P 500 next year, therefore?
Very difficult. I would say that the target should be around 4,700, 4,800, and it has this number embodies two things. First, we have not seen the end of the bond rally in the medium term, and you have the bond yield in the US going below 4% in 2024, and you are going to see some kind of median EPS growth, which is close to 6% next year. And with those kind of numbers, you can expect it to see this level of 4,700, 4,800.
Francois Savary, as ever, it's been lovely talking to you. Thank you very much. Bye-bye.
Bye-bye.